It was a fall from grace of epic proportions. One day, Sam Bankman-Fried, the tousle-haired supposed boy wonder of crypto, was rubbing shoulders with celebrities and politicians, a billionaire many times over. The next, he was a disgraced pariah, his empire in ruins, facing a future behind bars. How did FTX, a company valued at $32 billion, crumble so swiftly, leaving a trail of shattered investors in its wake? The answer, as with many financial scandals, lies in a potent mix of hubris, deceit, and a system ripe for exploitation. FTX, the cryptocurrency exchange founded by Bankman-Fried, or SBF as he was known, had positioned itself as the friendly face of the often murky crypto world. It promised easy access to digital assets, all while championing transparency and ethical practices. Big-name endorsements from the likes of Tom Brady and Steph Curry only served to bolster its image as a trustworthy and innovative enterprise. But beneath this veneer of legitimacy lurked a viper's nest of deception. When the truth finally emerged, the consequences were swift and brutal. Sam Bankman-Fried was an unlikely Wall Street darling. A self-proclaimed effective altruist, he cultivated an image of a nerdy genius, more interested in playing League of Legends and saving the world than chasing profits. Graduating from MIT with a degree in physics, he cut his teeth at Jane Street Capital, a quantitative trading firm known for its high-frequency trading strategies. In 2017, with the crypto market booming, SBF saw an opportunity. He founded Alameda Research, a quantitative trading firm specializing in cryptocurrencies. 2 years later, in 2019, SBF launched FTX, a cryptocurrency exchange that promised to be everything other platforms weren't: user-friendly, transparent, and reliable. SBF became a media darling, gracing the covers of financial magazines and speaking at prestigious conferences. Little did anyone know the seeds of FTX's destruction were already sown. Behind FTX's meteoric rise and SBF's carefully crafted persona lay a tangled web of financial chicanery. At the heart of the scam was Alameda Research, SBF's trading firm. What was initially presented as a separate entity, operating at arm's length from FTX, was anything but. In reality, Alameda served as SBF's personal piggy bank, a conduit through which he could funnel FTX customer funds to cover his risky bets. Central to this scheme was the FTT token, FTX's native cryptocurrency. By creating a vast supply of FTT tokens and using them as collateral for loans, SBF was able to artificially inflate the value of both Alameda and FTX. This, in turn, allowed him to attract more investors and continue the charade of success. FTT was essentially a house of cards built on thin air, its value propped up by nothing more than SBF's say-so and the complicity of a financial system blinded by greed and the allure of easy money. But the truth, as it always does, eventually found a way to come out. The beginning of the end for FTX came in early November 2022, when a leaked report from CoinDesk, a cryptocurrency news outlet, revealed the deeply intertwined and highly suspect relationship between FTX and Alameda Research. The report exposed how Alameda's balance sheet was heavily reliant on FTT, the very token that SBF himself had created and controlled. The revelation sent shockwaves through the crypto community. Doubts that had been simmering beneath the surface quickly boiled over into full-blown panic. Investors, fearing that FTX was insolvent, rushed to withdraw their funds. Within days, FTX faced a staggering $8 billion shortfall, unable to meet the withdrawal demands of its panicked customers. The house of cards, built on a foundation of lies and leverage, came crashing down. On November 11, 2022, FTX filed for bankruptcy, marking one of the most stunning and swift collapses in financial history. The collapse of FTX triggered a wave of investigations and legal actions. The Department of Justice, the Securities and Exchange Commission, and regulators around the world launched probes into SBF and his associates, seeking to unravel the complex web of financial misconduct. SBF, once feted by the world's elite, became an international fugitive. He was eventually arrested in the Bahamas, where FTX was headquartered, and extradited to the United States to face charges of fraud, money laundering, and campaign finance violations. SBF's trial, which began in October 2023, was one of the most closely watched financial crime cases in recent memory. Prosecutors presented a mountain of evidence detailing how SBF orchestrated a massive fraud, diverting billions of dollars in customer funds to fuel his own lavish lifestyle and risky trading strategies. The jury ultimately found SBF guilty on all counts. In March 2024, he was sentenced to 25 years in federal prison, a stark reminder that even in the seemingly borderless world of cryptocurrency, the long arm of the law eventually catches up with those who seek to defraud and deceive. The collapse of FTX left a trail of devastation in its wake. Millions of investors, from small-time traders to institutional giants, saw their savings wiped out. The crypto industry, already reeling from a bear market, faced a crisis of confidence. In the aftermath of FTX's bankruptcy, liquidators have been working tirelessly to recover assets and compensate creditors. The process has been long and arduous, complicated by the complex web of entities and transactions that characterized SBF's empire. In a rare glimmer of hope for those who lost money in the FTX debacle, a U.S. district judge approved a plan in October 2024 for the reorganized company to repay 98% of creditors 119% of their claims. While this doesn't erase the pain and hardship caused by SBF's fraud, it does offer some measure of justice and a chance for victims to rebuild their lives. The road to recovery will be long and challenging, but the FTX saga serves as a stark reminder of the importance of regulatory oversight, investor education, and personal responsibility in the often unforgiving world of cryptocurrency. The FTX debacle is a cautionary tale, a stark reminder that even in the seemingly cutting-edge world of cryptocurrency, the same old rules of risk and responsibility apply. The allure of easy money, coupled with a lack of regulatory oversight and a culture of hype, created a perfect storm for fraud and abuse. So, what lessons can we learn from the FTX abyss? Firstly, skepticism is our friend. Don't be blinded by hype, celebrity endorsements, or promises of outsized returns. Do your own research, ask tough questions, and be wary of investments that seem too good to be true. They probably are. Secondly, understand that not all that glitters is gold. Just because a company is big, well-funded, and has a charismatic leader doesn't mean it's immune to fraud. In fact, the bigger they are, the harder they fall. Let's learn from this experience and work together to build a more transparent, accountable, and equitable financial future.